Ladies and gentlemen, you're looking at this right, baby. Stitch Fix. We're talking about Stitch Fix today. Just reported some earnings. That's right. That's what I'm talking about. You're not seeing this chart incorrectly. Up 34% after hours. What the crap is going on? What kind of an earnings report is this? Up 34%. I thought for a second when I was looking at this there was an issue. I thought there was an issue, and we made a mistake here with this stock chart, but it turns out we didn't. Okay, this is the real deal. Now, where it ends up in the morning, who knows? But for now, the stock shot up over to $48. I mean, you're talking about incredible stuff. So let's take a look at these earnings and see what could have caused such a thing. Well, let's just take a look here. Stitch Fix posts a GAAP EPS of 9 cents, which is a beat by 26 cents. That is what I would like to call incredible. Now, why I say that's incredible is because this is a company that historically has issues with profitability. It does. And the fact that in the midst of a little bit of a, as they might say, pandemic is the buzzword. That's the buzzword of the year. They posted a positive EPS line, beautiful, and a big beat when they were expected a negative one. Really good there. And a revenue of $490 million, which is up 10% year over year, beats by $9.3 million. Pretty good. If you recall, I did anticipate somewhere between an 8 to 10% gain, and they even surpassed my expectations. Are you kidding me? Now, what's really, really nice here is this active clients of right around 3.8 million compares to a consensus of 3.65 million. So, great improvement there, absolutely. Annual net revenue per client did decline 4% year over year and didn't quite hit the consensus, and a lot of that's because of the increased client base. As you get more clients, you'll get a lot more that are not going to be necessarily purchasing quite as much, so that's kind of where that goes. I still don't see what necessarily is leading to this. So let's see. Let's see if we can find anything else. Adjusted EBITDA was reported at $6.9 million, easily topping the consensus of $2.7 million. From the CEO, our powerful personalized engine is evolving, and innovations in our fix and direct buy offerings will expand our addressable market, deepen client engagement, and grow wallet share over time. We're excited about the momentum in our business, confident in the future, and we expect to deliver between 20 to 25% growth in the full year. What the freaking crap? Holy schmoly. What is going on here? So that's pretty wild. Expecting that big a growth for this company is pretty massive. They don't typically grow at a rate like this. And I think that's why you're seeing a little bit of not a little bit of movement, a big bit of movement. You don't see the company grow typically at rates like that. So these words by the CEO, let me tell you, selling the stock. Selling the stock. They're expecting quarter two revenue of $506 to $515 million versus a consensus of $509. So right along with that, full year revenue of $2.05 billion to 2.14 versus a consensus of 2.01. So for the full year, definitely a beat on consensus. If we're talking about the corporate level, Dan Jetta was appointed as the new CFO. Jetta joins the company from Amazon, where he was vice president and CFO of digital video, including Amazon Studios, digital music, and the advertising and corporate development organization. You might ask how that necessarily transfers. Well, big name from Amazon, obviously the biggest online retailer, makes people get probably a little bit excited that he could bring some good stuff along the line here and bring it to Stitch Fix, so that way they can do a good job in terms of online clothing sales. Well, we'll take a look. I think that definitely helps get people excited, no doubt. Let's look at their press release. Press release, baby. Active clients, as we saw, increased 10% year over year. Pretty good. And increased 241,000 clients quarter over quarter, which is pretty darn good. Net income was $9.5 million. You like to see that? You do like to see that. I think that's really good. So that's really their press release there. So again, what is the reason for this movement? And I think a lot of it is this stock has had a lot of recovery. I don't think you can deny that. But I did also want to say, overall, compared to the rest of the market, this is a, frankly, tech company. I'm going to call it a tech company. They operate entirely off of e-commerce. And they have not gone along with the same valuations as your others. I mean, look at the last 5 years of this company. Not much movement, all around 136%. It's pretty darn good. But overall, you see a lot of just flat here. I mean, if we look from December of 2017 all the way up until even, through September of this year, there wasn't movement at all. I mean, the stock was flat. So you need to consider that too. This stock hasn't quite taken off like some of the others. Even year to date, stock's up 42%, where a lot of other both retailers and tech companies have been up quite a bit. So I think that has something to do with it. Should be something to mention. And I do think overall valuation was pretty cheap. Prior to this after-hours move, was trading in a market cap of $3.75 billion with an annualized revenue a little bit under $2 billion. So with that said, I mean, it was trading at some very cheap valuation. And if you talk about bringing profitability into the picture, which they just did, that adds a lot to this company. Not only can it attract value investors, but obviously the growth investors, when they talk about 20 to 25% growth rate expected this upcoming year, that gets a lot of people excited. So you need to consider that. Let's look at the balance sheet real quick. Obviously something that excites me, no doubt. Let's see. Total current assets on this company. What? Now this one, they upset me. They only give me a 3-month comparison. Don't like it that much. I want 9 months or a year, okay? But $597 million in total current assets compared to $466 million of 3 months ago. Total assets in general of $880 million compared to $769 million of 3 months ago. Well, from a liability standpoint, total current liability sits at $295 versus a $215, or a $212, I should say. And total liabilities in general at $451 versus $361. So you did see assets rose more than liabilities. Pretty good to see. I can't lie to you. So total stockholder equity is now sitting at $428 compared to $401. The balance sheet's actually really good on this company. I really like it. It's a relatively small balance sheet. You need to mention that, but I do think overall it's a pretty darn good looking one. They're doing a great job doubling the assets in terms of compared to liabilities, pretty well double the assets. The company does a lot here. Balance sheet looks good. Katrina Lake, you're doing a pretty darn good job right now, and I can see a lot of good stuff going on for this company. As far as purchasing, well, I mean, with it being close to now $50, son of a gun, $48.60. The valuation gets a little bit more steep. I can't lie. I still like this company long term, though. I really do. I mean, I'm up now 200% on the position, so it gets me pretty excited in that aspect. I like that. I told you to buy it a while ago. What can I say? When it was $15, I told you to buy it. But I wish I'd bought more, I'll tell you that right now. But I still think there's value if you're talking about long term. Now, I don't know what the short-term play is for this company, If they have a bad quarter next year at all, I mean, I think this stock could get hit pretty hard. But we'll see if it even survives these 35% gains they're showing right now when we talk about looking into tomorrow. I don't know. So, pretty exciting stuff. That's what I got for you today. I hope you enjoyed.